This is Mark Warner with PropertyMortgageInvestment.com and wanted to continue my series about residential property investments versus other mediums of investment. And today I'd like to talk to you about commodities. And most of you know commodities as pork barrel, gold, silver, other precious metals that might be a commodity that you could purchase on the market, or a contract against the fluctuation in the price on those commodities. Wheat is another example. So when you look at a property real estate investment, you have price appreciation, which is one of the areas of potential return. Obviously, in the market we've just been through, real estate properties have devalued in price. You look for cash flow in a rented property, and then the tax savings because the government allows you to depreciate, and then if you finance those properties to enhance your return, thus increasing the risk a little bit, you also get other people's money paying the debt service, which again, a portion of your payment goes into the reduction of your debt, which is essentially a return on your investment. In the commodity world, what you're looking for is specifically price appreciation. Now, the commodity can go in either direction, which, depending on which direction you're betting on, if the price goes down and you put the appropriate facility in place, you can make money. Otherwise, you put the appropriate facility in place, and if the price of wheat or oil or whatever commodity you're buying goes in the direction that you hope it goes in, then you can make a lot of money. You can leverage that, and most people do leverage in the commodity market. So there necessarily isn't any debt reduction to that. It just enhances what your potential appreciation is. The risk is significant. You can lose a lot of money in a very fast way. So you need to be really careful as to how you trade in the commodity markets. But there's really no cash flow. There's no tax savings unless you buy it at one price, sell out at another, and you have a tax loss, which again allows you to write off a portion of that money, depending on how long you've held the contract, mostly short term. And there's, of course, huge leverage in it, but typically there's nobody else that's servicing that debt for you in that leverage. In terms of liquidity, it trades much like you would with any other commodity and any other stock, so you can get out of it fairly quickly if you want to price out of it. So, in comparison, a residential real estate property has it all over a commodity. Some people like a portion of their portfolio in a commodity situation where they can make huge returns. However, there's huge risk, and it doesn't give you the solid basis of a piece of dirt with sticks and bricks on it that produces all four areas of return in comparison to a commodity. This is Mark Warner with PropertyMortgageInvestment.com.